TV. This program is brought to you by Rogers Xfinity, connecting you to more of what you love. Visit Rogers.com for more details.
There we are. Hi again, everybody, and welcome to Living Well, Giving Well on Rogers Television, Grey County. I'm Fred Wallace, co-hosting with Denise Reid today on Living Well, Giving Well on Rogers Television. Coming up on our program today, we'll have a featured video from one of our sponsors and one of our supporting charities, that being the YMCA of Bruce Grey Owen Sound. We'll be talking, or we'll be seeing a video where they showcase their many, many services to our community. Our guest today will be Peter Morgan from Cooperators, located in Meaford. But before we get to Cooperators in Meaford and Peter Morgan, we want to take just a second and talk about Living Well, Giving Well and what our program is all about.
Well, this is 30, right?
Yeah, number 30.
30th episode, which is amazing. Can't believe we've done that much so far. But Living Well, Giving Well was a concept put together with Stuart Reid of the Community Foundation and Willard Vanderploeg from the Bright Shores Hospital Foundations. And the title's good, Living Well, Giving Well. How can we live well in our community? How can we give well, whether that's through donations, through your time, your money. It's always a good feeling, living well, and then if you can give well. And we've had lots of different people on the show, and so today Peter's gonna talk to us about life insurance.
Very good.
And how that affects in your estate as well.
And just before we meet Peter, we always remind people to go to Willpower.ca. It gives you some remarkably easy steps, lots of great information, and also it debunks a lot of myths about how complex giving can be. It's not complex at all. So Willpower.ca is a great place to go. All right, now let's meet our guest, because I take it you're extremely familiar with our guest today.
Well, I do know Peter, and I mean, I'm going to give it away. When I was looking at my notes, I had Peter Morgan. Well, your nickname that I know is Pimo.
That's right.
Right? So makes sense, Peter Morgan. So pleased to have you on the show. And talking about life insurance. Okay? I know sometimes people like life insurance, car insurance, house insurance. It sometimes gets a little complicated in that. But when I was looking at my notes, the first thing is term and permanent life insurance. Tell me what that's about.
So life insurance is essentially broken down into two categories. There's term coverage. So term coverage will cover you for generally somewhere between 5 and 30 years. And if you were to pass away in that time period, then the death benefit would be paid out. So term is a temporary solution for a temporary need. So for instance, you plan to have a mortgage, usually for 25 years. Your kids will only be financially reliant on you for 25 years, hopefully.
Hopefully.
Right.
You winked at Denise when you said that.
Yeah, hopefully.
And then we've got, on the other hand, permanent coverage.
Okay.
So permanent coverage, you're going to put it in place and it will pay out regardless if you pass away prematurely in your 40s, 50s, 60s, or late into your 90s or 100. So permanent coverage is a permanent solution for a permanent need. Term coverage is a temporary solution for a temporary need.
Peter, we've talked on Living Well, Giving Well about getting the start with the will, and the earlier the better. Is there a primary time or a priority time that somebody should start thinking about this and actually acting on it and putting a policy in place?
So as soon as someone is depending on you financially, that would be one of the key moments that should spark it in your mind that I should have life insurance. So that if I was to pass away and I have a spouse that depends on me financially, I would want to make sure that she is taken care of or he is taken care of. Or if I have kids that depend on me, that they're going to be taken care of if I'm no longer here with my greatest asset, which is my ability to earn an income.
Okay. So, I mean, interesting, as I have a 33-year-old son, you know, and his wife, he has somebody that's depending on him. Although if you talk to her, she's a very independent woman, has her own job, so maybe not. But there's a case where, because we started, I think, way too late, whether it be on wills.
With the will, not so much with the life insurance.
With the life insurance, yeah. So that, the earlier the better.
Earlier the better. As you get older, life insurance gets more expensive.
Right.
And as life goes on, there's more of a chance that your health may deteriorate and you may not be able to get coverage, or if you can, it may be at a higher than the standard rating.
Right.
Yeah,
so that it depends on I mean, there's probably qualifications, is there?
Yeah, there's health underwriting. So generally speaking, you're going to do an application and a questionnaire about your health history, smoking habits, drinking habits, etc. And then they call it the age and amount requirements. So depending on your age and the amount that you're applying for, then the underwriting can be different. So as you get older and there's a higher amount that you're applying for, there's going to be more underwriting. So it could be a blood and urine sample. We could require a note from your doctor, things like that.
So because once you establish a life insurance policy, whether I guess I'm looking at a permanent life insurance, I mean, that's good until such time that
exactly, yes, you're set. And same with term, that you are set. You don't have to go through your health underwriting again for that entire term.
Using Denise as the example, can she go from term to permanent? Because I don't think her kids are going to rely on you anymore.
I hope not.
At one point, I'm sure they did, but and same with Brian. So
yeah.
Can you make that transition?
Wonderful question.
Thank you.
Generally speaking, yes, if you do have a term policy, you'd have to look through your policy and ensure that you have what's called a conversion privilege. So you can convert your term coverage to permanent, and there's usually a time frame. Some companies it may be before the age of 65, some companies it may be before the age of 70. But that is a huge benefit, that if you have this term coverage that you have been approved for back when you were, let's just say 30 and you were super healthy, you have a 30-year term. Now that you're approaching 60, let's just say, your term is going to renew or it's going to be complete. You have the option to convert this to permanent coverage without doing health underwriting. So you may have a need for permanent coverage, whether that's simple just final expenses such as funeral costs. It could be something a little bit more complicated, such as taxes that are going to be owed based on maybe it's corporations that you own, etc. But if you can't be approved at that time because of your health, you have that conversion option that we're guaranteeing you keep that same standard rating and you convert up to that policy amount.
So when I'm not sure if I understand term and permanent. Like an example, like if you have a mortgage, like I know the banks, because I worked at the banks, they offer insurance there, but you can get life insurance. Would that be a term?
Generally speaking, yes. So we were talking about earlier, a temporary need should have a temporary solution. So your mortgage is temporary. And term coverage is the most affordable way to get life insurance during the time period that you need it most. So you could apply for permanent coverage, but if let's say you have a $500,000 mortgage, $600,000 mortgage, and it's not uncommon to see that these days.
Right.
If you were applying for permanent coverage, it's going to be pretty expensive. So generally, people in that scenario, they're looking at term coverage.
Okay.
Our guest is Peter Morgan today. Peter is with Cooperators in Meaford. Are your clients well educated before they meet you? And I ask this because I'm with Manulife and I'm with a Ryerson policy, like a student policy that started when I graduated in 1982. All I do, I wouldn't say that I was overly educated. Can you tell me, are your clients educated before they come in, or what can they do to be more educated as opposed to what I was?
Yeah, another good question. I don't think that the clients are educated enough.
Right.
I don't think it's accentuated enough that people need life insurance. You see all the time on Facebook and things that somebody passes away prematurely. They're passing away in their 30s, they have a young family, and you see the GoFundMe page. That's the worst thing that we can see. We don't want our clients to be relying on crowdsourcing their income replacement to ensure that the family can remain stable financially.
Right.
So there's definitely not enough education out there. It's not something that people generally come to us and ask about. It usually comes up in our conversations when we're talking about their commercial insurance or their investments.
Right.
That we usually have to bring it up to them. people, no one ever, they all think they're invincible. We don't think that it's going to happen to us, but it's good to have it just in case.
Well, we've learned through doing this program with having the lawyers, the accountants, like it's a hard conversation to have when it comes to not living.
Yeah.
I'd say, Dad, not living. And whether it be your will, have you done your will? Have you got life insurance? People just don't want to talk about that. But if you already have them in, and we're talking car insurance, and we're talking house insurance, or whatever it is, then that's a great opener to be able to educate people.
Yeah, we get calls all the time about people wanting us to quote their car insurance or their home insurance, but the phone doesn't ring enough for life insurance. There is such a need for it. People are so uncovered or underinsured in Canada. I really do wish people would think about it more, but it's one of those things it's easy to put on the back burner.
Okay. How do you, if you had a way or a method, how would you educate our viewers and me and Denise in terms of being better informed about our life insurance, because we protect the vehicles that we drive, we protect the homes that we live in?
Yeah, I think it's just having a conversation with your friends and loved ones and your advisors. So, people always talk about the new car that they bought. They talk about, I got the new Nikes, whatever it may be, a new driver for golf. But no one says, hey, I sat down with my advisor and I put together a plan that if me or my spouse passes away, that the other one and the children are going to be looked after. It's not something that is brought up enough, but when you get a good plan in place, I really do think that you should educate your friends, family, and just, I would say, give them a little nudge to talk to somebody if they haven't already.
Doesn't hurt.
I think that, when you look at, if somebody is employed and has life insurance with their job, I think people think, oh, that's enough.
They do.
But self-employed people, people that don't do that, I'm not saying that they need it more, but there is at least some, fallback here.
Yeah, you know what, Denise, I'm glad that you brought that up, because there is a false sense of security when people have the coverage through their workplace. It's often 1 or 2 times your income, which, let's say if you have a couple, they're both earning the same amount of money. Let's say they both earn $50,000 a year. If one of them is to pass away and all they have is 1 times your income, which is pretty standard on a group policy through work, then nothing changes as far as the household income for 1 year, but life goes on a lot farther than 1 year for the surviving spouse. So even if you do have that coverage through work, you should be having that conversation with your advisor. And who knows, you may not be with that employer forever. They may not keep those benefits forever. You shouldn't rely on your workplace coverage as the only insurance.
Yeah.
This is Living Well, Giving Well on Rogers Television. Peter Morgan from Cooperators in Meaford is our guest. We're going to take a quick break. One of our coordinating sponsors and charities that is joining us on Living Well, Giving Well is the YMCA of Bruce Grey Owen Sound. We're going to watch a short video on their program and showcase their activities, and then we'll be back with more with Peter Morgan as we continue with Living Well, Giving Well on Rogers TV.
Hi, I'm Sarah Cowley. I'm the CEO for the YMCA of Owen Sound Grey Bruce. Our YMCA is a charity that's dedicated to building healthy communities and safe communities and inclusive communities, and we do that through offering opportunities for every individual, no matter their age or situation, to grow in mind, body, and spirit. We provide early learning child and child care programs. We provide health and wellness and fitness supports in our Health, Fitness, and Aquatic Center. And we also provide community supports through our community initiatives like homelessness prevention programs, settlement and language services, justice programs, and programs for youth who are transitioning through the care system. The way our donations help across the association, and certainly facilities, because we do have facilities that we want to keep up for the next 100 years. We want to be providing services from those sites. And we know in order to keep our fitness facility and our sites running, we are going to need quite a significant amount of money over the next 10 to 20 years to keep going. Costs are rising, families are seeing the cost rising. We've seen a significant increase from $83,000 in subsidies last year to almost $150,000 subsidies paid this year. at the end of 2023 for our fiscal year. And so we know people are struggling, and we know that people see their health and wellness and some of the services that we provide as a want rather than a need, when really it is a part of their total health. And so we need the community, the Y needs the community to continue to help us to build healthy communities. Without the Y, without the services we provide, many people will continue to struggle. And so we would ask for donors. Without donors, we can't continue to provide the services we are.
Welcome back, everybody, to Living Well, Giving Well on Rogers Television, episode number 30 of our program. I'm Fred Wallace, along with Denise Reid, and our guest today is Peter Morgan. Peter is from Cooperators in Meaford. And before we get back to Peter and some questions that Denise has pertaining to life insurance specifically, just want to go back to our video for Living Well, Giving Well today and the YMCA of Bruce Grey Owen Sound. Obviously, you saw some marvelous shots of a great facility. We do want to do a special congratulations from Living Well, Giving Well to Tom Rice and Sonia Mount. They both received very recently the King Charles III medallions. Those are the King Charles coronation medallions, and obviously certainly well deserved. I see Tom Rice on a regular basis at the YMCA, and I know that he has to be absolutely thrilled with that facility and his vision coming to fruition and what it provides for the community. And as it pertains to Sonia Mount, you and I talk about this all the time, that if you're involved in a community activity or you're involved in a charity, suddenly you see the merits of that charity, and the Mount family, Sonia, Debbie, Peter, Perry, and Paul, have been involved in the Y going back to the 1960s, certainly in Midland, Ontario, and now, so congratulations to Sonia and to Tom. Back to our guest today. Peter Morgan is our guest from the Cooperators.
Yeah, I wanted to ask Peter because we talked about when should you get life insurance, and we talked about as soon as you have the responsibility for somebody else. I mean, there are people, couples having children.
Yeah.
Okay? So when you have children and you get life insurance, do they become the beneficiaries? Or if they don't have a will and don't have an estate, what happens there? What do you recommend?
So you do not need to have a will to have life insurance and have a beneficiary set up. It's something we absolutely do recommend. What we're seeing generally, if there is a couple and they're having children, they will most often have each other. The spouses will have each other as the named beneficiary. And what is a beneficiary? The beneficiary is, if you were to pass away, that is who the life insurance death benefit is paid to. So it's most often the surviving spouse, and then the surviving spouse is taking care of the family, so that's who the death benefit should go to in many cases. However, there is a case where both parents may pass away at the same time. So most common example that I would bring up is if it's a car accident where you're both together and you're both pass away. If the beneficiary is not there, then there's no one to pay the death benefit to. So what we would do in a situation like that is you would have a contingent beneficiary. Okay. So oftentimes the contingent beneficiary, they would name their children, but let's just say your kids are 2 and 4.
Right.
You're not going to give a 2 and 4-year-old $1 million death benefit. Okay. So what you can have is a trustee, and those funds will be held in trust until the children reach the age of majority or an age that you have put on the policy.
Okay. So between you then and the trustee, that's being taken care of until the age that the kids get of the age.
Yeah, and you can choose. It can be 18. When I was 18, I probably wouldn't have been ready to have a $1 million check.
Exactly.
So you can choose later in life. So we often see people doing 21, 25, 30, whatever it may be. And another point on that, you should be having a conversation with the trustee before blindly throwing them on. Okay. And it is a good idea to have a will, because this is the financial trustee, but you also should have a guardian set up. Should they be the same person? They can be, not necessarily. People have different views on that, maybe based on the strengths and weaknesses of the guardian/trustee. But you want to have it set up in a way that you're comfortable with, and you have a conversation with these people who could potentially be carrying for your children as a guardian and financially caring for them as well.
For sure.
Do you set up your beneficiary before you set up the policy? And I ask this because with my Ryerson policy, my sister is the beneficiary, and unless she's watching this program right now, she has no idea that she's the beneficiary.
So when you fill out the application, it usually has a spot for you to enter the beneficiary. But generally speaking, you can change the beneficiary at any time. Okay. So just a little hint, if you don't want your sister on there. sorry. But it may be revocable.
Yeah.
Okay.
So I had to look at my notes for this too, because I really wasn't quite sure about this. And what are the different benefits and reasons why somebody would hold life insurance in their corporation? So I'm assuming this is a person that is self-employed?
Yeah. So let's just say that we have a self-employed individual who has built up their corporation, or maybe their holdco with assets. The easiest example I would say is real estate, because a lot of people understand it. They know how it can grow over time and appreciate in value. So let's say that someone has 10 properties, and let's just say a round number, they're worth $1 million each, and they're in a corporation. So those properties, they likely didn't buy them for $1 million. They may have purchased them periodically over the last 30 years. So the value of their corporation has increased over time, and which is a really good thing for the owner of the business.
For sure.
It's also a really good thing for the CRA, because the capital gains tax is likely going to be pretty substantial. And the capital gains tax, there may be, and there likely will be, a personal capital gains tax that's owing, based on the growth of your shares in this corporation. And a lot of these business owners, especially in real estate, their capital is tied up in those assets in their corporation. So what happens when they pass away? Let's just say they have $1 million of taxes owing when they pass away. All their assets, or the vast majority of them, are tied up in real estate within their corporation. Okay. So in order to pay that tax, they have to liquidate some assets in their corporation, which you never know with market timing. We've seen the real estate market over the last year and a half. Might not be ideal to sell at that point. And so you maybe have to have a fire sale, and you're selling lower than what you think the value is. And then you have to pull the money out of your corporation. And anyone listening who's self-employed, when you're pulling money out of your corporation, you're dividending it out, and you have to pay taxes upwards of 50% on that. So if you have $1 million of tax, you may have to take out up to $2 million from your corporation to pay that $1 million of tax.
So it's easy. So not easier, but you need to have a policy for that. It's recommended.
It's recommended in a lot of these situations. So the benefits of having it is that you're paying for this policy with corporate dollars. So rather than paying personally after tax, you're paying with your corporately lower tax dollars. Many of the policies will grow over time. So the growth of the policy is tax-free according to the CRA tax code, which is fantastic. There's really not a whole lot of places you can grow tax-free.
It's not often you hear the CRA patted on the back.
Yeah, well, you've got the tax-free savings account, your principal residence, and life insurance. So you're using with lower tax dollars. It's growing tax-free. And one of the biggest benefits is that the vast majority, and in some cases all of the death benefit, can be paid out of the corporation as a capital dividend, which means a tax-free dividend. So rather than needing to pull out, in this situation, they're using round numbers so it can be approximate, rather than pulling out $2 million from your corporation to pay $1 million of tax, you would only need to have $1 million of death benefit. These are round numbers. Exact.
And does it become more complex if it's a partnership, if Denise and I have the 10 properties?
Yeah, it can be more complicated based on the corporate structure. But I would just encourage having that conversation and working with a team, working with your advisor, whether it's your financial planner, insurance advisor, your accountant, and your lawyer. When everyone works together, I think that's when you can come up with the best solutions.
Personally, do you have lots of corporate work, Peter?
A lot of corporate work. So because we do a lot of commercial insurance, so we're dealing with businesses and business owners all the time. And we do work with a lot of business owners.
Is it difficult treading sometimes?
I would say not necessarily, to be honest. I think that business owners, they understand the need for this. And sometimes I think people who have a more difficult conversation is the more simple one when you're trying to set up a simple term policy for someone who just had their first kid or bought their first house.
Yeah.
But when you speak with business owners, and generally speaking, they understand the problem that, hey, my accountant told me I have $1 million of taxes that are going to be owing if I was to pass away today. He said to talk to you, Peter, to find the most efficient way to cover this tax liability.
Yeah. And I think that's, I mean, with businesses, a lot of them are trying to look at how can I avoid paying the government, all that. So they become a little more knowledgeable, I think, on that as compared to the simple...
Yeah, and when we're speaking to a business owner, this is a permanent problem. You are going to pass away at one point.
Yeah.
So, let's start planning for it efficiently now. Whereas when you're speaking with somebody, you're talking about a term coverage, everyone thinks they're invincible and it's never going to happen to them. So it's easier for them to put on the back burner and say, call me in 6 months, I'm busy.
Yeah.
Whereas the business owner says, well, it's going to happen eventually. We're going to need to do it. And I'm only getting older and my health maybe isn't getting better.
Yeah.
So be prepared. Before we let you go today, Peter, life insurance as a gift, because we're talking about living well, giving well, and leaving to charity. Is there an avenue that can be accomplished?
Definitely. So there's a few different avenues that you can take. So let's just say if somebody, and this is an example that people come in, not terribly and often for this, they say, I have this life insurance policy. It's a permanent policy that we set up and it was supposed to be going to my kids. Maybe it's $50,000.
Right.
But now my kids are more wealthy than I have ever been in my entire life. They don't really need it.
Right.
So you can change the beneficiary to a charity, and then upon your death, the death benefit would be paid to the charity, and that is when the charitable tax receipt would be processed and given to you. It's in that final tax year. Okay. So you can change the beneficiary, you can put a new policy in place that the charity can be the owner. And if the charity is the owner from the onset, then as you're paying those premiums over the years, you are getting the tax receipt with the premiums that you're paying rather than the death benefit. So there's different avenues you can take for when do you need the charitable tax receipt? Do you need it now or do you need it later?
Peter, how do people get in touch with you?
Best way to get in contact with me is through email. It is peter_morgan@Cooperators.ca. You can give us a call at the office, 519-538-2226, or come in and say hello.
Okay, well, thank you very much for joining Denise and I today on Living Well, Giving Well on Rogers TV. We want to thank our host charity today, that's Bright Shores Health System and the Foundation, and also again to our supporting charity on the featured video today, the YMCA of Bruce Grey Owen Sound. Coming up, we'll have more editions of Living Well, Giving Well, so stay tuned right here on Rogers TV, Grey County.
Connect with us by visiting our website or email us at comments@rogerstv.com.
You're watching an interesting local show on Rogers TV and you want to know more. That's when you head to rogerstv.com. Our website provides more information about our programs, our hosts, our schedule, and about how you too can get involved with Rogers TV. Visit us online at rogerstv.com.
Are you a passionate content creator ready to expand your audience reach? Do you have unique stories, captivating hobbies, or special interests that deserve a spotlight? Rogers TV is here to amplify your voice within the community. We offer you the platform to broadcast your content to a wider audience.